In our private section, we focus on the capital activities and the impact on balance sheet, changes in partners' capital, cash flow, and the schedule of investment. In this section, we are moving our focus to income statement. We're going to study the expenses, income, realized and unrealized gains and losses. There are many different types of expenses occurred during a fund operation. I just pick up a few typical ones as example. Basically, there are three types of entries I'm going to introduce. The first one is just a simple cash paid fees. Whenever those expenses occurred, we're going to just credit the cash to pay. The second type is accrued expenses. And the third one is we're going to set fee payable, then pay next month. Hopefully, we could have a good understanding of how to book fees after these three types of examples. All right, let's go to our budget. The reason I keep showing this budget tab is because in real work, you would have a lot of receipt request or document for you to book the entries. Right now, we don't. We just put all this information into this tab to manage the operation request. For example, in this expenses budget, we listed these fees. For legal fees, we're going to debit the legal fee expenses, credit cash, and cash equivalent. We just set this to pay every single month when we receive the receipt. Of course, we can set up the payable, then counter the entry. But here, we just use it as simple. Otherwise, this file will have way more rows. And I think the concept is very easy to understand to skip this payable anyways. So we have our legal fees for the rest of the year since we set up a 12 month. If we set up these legal fees 10,000 and now our entry changed, the debit amount cut into half, then we are going to do the direct fee as well. We're going to pay back cash every single month. Again, we are building a model. During a real operation, you would book these monthly entries probably each month. And then we have this data marketing fees. We set up here 833 each month. And for the fund admin fee, I set up this situation is we know this is a fee we're going to allocate the entire year's service. We have this service agreement with the fund admin that we're going to pay $60,000 a year. So for every month, we're going to accrue the expenses. And then in December, we will have additional entry to counter the accrued expenses when we pay this $60,000. Right now, we set as a fee payable. This is the service year. And we may pay by the end of the year. If in that case, we will put a cash entry. But if we pay next year, the cash entry will go to next year's book. So this is a payable accrued expenses situation. And this is just a very simple payable and we flip to the cash payment entry next month. For due diligence fee, we're going to debit the expenses in prior month and we set up as a fee payable. And then in next month, we are going to counter the payable and we're going to pay cash. One more type of entry I think is very typical, but I did not use here. It's prepaid. For example, I think insurance is very typical. You would prepay the insurance in the beginning of the time period, 1 year or half a year. We're going to debit prepaid insurance, for example, $10,000, and then we're going to credit cash for this $10,000, right? When this insurance expense occurred, we will debit insurance expenses, and then we will credit the prepaid insurance. I did not book that entry. That is just another example. All these expenses will come to our income statement. I grouped all these expenses into professional fees. They could be presented very differently on different funds. So this is just the example. So this is a year-to-date income statement. The way I set up the entry is I'm going to, based on the date between the current quarter and the end of last year, we're going to pick up the numbers in column L of the journal entries tab. And the reference is column M. So for all the fees, I have all these expenses grouped as professional fees. That is how all these expenses come into professional fees. If I want to group differently, I just need to change my chart account. So for example, my income statement shows my professional fees 107,750. We're going to make this other professional fee expenses not our fee anymore. So in our journal entry, you will see these fees are not even here anymore because it's not included in our income statement. Then in our income statement, my range is a little bit different. Now you can tell because I list all these typical fees expenses here. It shows zero because one of the fees is not there anymore, and that is category zero, and this does not show right. If I get it back, this is a professional fee, and my income statement do need to still come to my range. A good way is just how to copy the income statement items. I was just doing testing, so I try to make all this in a very automated way. Anyway, now we have our professional fees. These are the entries. After the income statement, and then we have our cash flow. So in this cash flow, we increase our accrued expenses from the fund element. Each month is $5,000. And we have a quarter here that's worth $15,000. This does not impact our schedule of investment. And we have our other fees. These are just the notes here. You could see many different types of other fees, and you could have different types of entries. Now we go to our income. Dividend income and interest income are just the most common income for a fund. In our business plan, we assumed we would get a monthly income from the laundromat, and we book that as dividend income. You could set up differently. This really depends. We can just set up operating income, and we can book this as other income. In the world of fund, we actually invest in a lot of other companies. And I just want to give you the example as dividend income. So we have dividend income each month received as cash, and we debit cash and credit the dividend income. And for the e-commerce, as we also mentioned, we set up this dividend income monthly. And then for our AI tech company, we don't have anything. There's no income entry for this company. And for our e-commerce company, we mentioned that this is quarterly. So by the end of every quarter, we would have some income. As we invest in this company in May, so there's nothing booked in the first quarter. We can only book a partial of the income because the company only hold a 1 month interest in the second quarter. That's why we have divided by 3. So income here, I divided this monthly income into 3. So this is the dividend income from the e-commerce. And then the rest of the year, we would have the dividend income from e-commerce each quarter by the full amount. So this is the same entry we have here. And now we're going to deal with our interest income. Interest income is very simple. For our loan investment, we receive cash payment from our borrower. It's just like your house. You would pay your mortgage every single month to a bank, and your bank would have a similar entry like this. As fund manages money, we debit cash and cash equivalent to flow into our cash balance. For the amount of money we received, a portion of it is the original principal, and the other part is the interest income. That's why we have the loan schedule here. For the e-commerce loan, based on this principal and 8% of interest, we know each month we're going to have $62,672 payment received from the borrower. For every single month, we have our principal amount. The credit here, we credit loan note receivable, $49,339. And then we credit the interest income, $13,333. This entry is not the same because your loan payment is the same every month, but your principal decrease every single month. Based on the new principal, the interest income will decrease accordingly. In a lot of situations, the ERP system hopefully will automatically populate the monthly entries for you in real world. In our model here, all the numbers back to our loan schedule. We look up based on the effective date. So this is a full year entry for the e-commerce. We set up the first one into June 30th. And then for our prepaid loan, we're going to book the same entry. It's the same situation. We're going to debit the cash, and we are going to credit the loan receivable and the interest income. So these entries are for the income from our loans. In terms of the impact to income statement, we booked our dividend income, $36,667 here. We have a dividend income in the first quarter. Then this interest income comes to a second quarter. This dividend income, $36,000. So in May, this is our dividend income, $36,000. And then in June, we're going to have $100,000. So this is how I tie everything. I need to make sure my cash flow in my budget ties to all my statement. And then we have our interest income. It's nothing by the end of the first quarter. It's $50,000 in Q2. Income statement in Q2. So these numbers come from our journal entry tab. And these budgets number are based on the operations. So two type of analysis or books, they should tie each other. This is the fundamental concept. Next, we're going to realization and valuations. The realization we actually already booked. That's why I don't have dates here anymore. I don't have TB tagged here. When I use SUMIF to pick up the entries from here, I have this column used as my reference because this entry we already discussed in our distribution. So this is just for reference. When we sell our AI company, I explained that we debited the cash we received, credit the fair value, and credit realized the gain or losses. Go back to our capital distribution. We have our journal entries. So this is the entry we booked for the realization. Here, I set up here to remind you the process. There's no number here. Then we have our unrealized. So for unrealized, normally the fund would do a quarterly valuation for their investment. Here I only use one because the process is the same. You just need to book entries for every quarter. And for valuation, it's another type of professional service. You would have your portfolio company give you the valuation, or you just hire some vendor to provide a valuation. So for example, very typical for real estate, you would have an appraiser send you the valuation every quarter. Mostly. For our investment, we just assume our e-commerce company increased value by $1 million by the end of the year. So we debit the value $1 million and then we credit the unrealized investment gains. These unrealized gain will increase our asset value. And this goes to the income statement unrealized gain here. So by the end of the year, our value increased by $1 million. And then this is our realized gain we mentioned earlier. Okay, hopefully this quick walkthrough on the entries of the income statement will help you to understand how these numbers and entries and financials relate to each other. Next, we will move to our fees.